Hey everyone, welcome back to MoneyWise, where we break down personal finance and smart investing tips. Today, we're diving into one of the simplest and most effective investing strategies out there. It's called dollar cost averaging, or DCA. And stay tuned to the end because I'll also show you how to turbocharge this strategy for even better returns if you're ready for a more advanced approach. What is dollar cost averaging? Dollar cost averaging is a strategy where you invest a fixed amount of money on a regular schedule, like every week or every month, regardless of what the market is doing. For example, let's say you invest $500 every month into the S&P 500 through an ETF like VOO. If prices are high, your $500 buys fewer shares. If prices are low, your $500 buys more shares. Over time, this smooths out your cost and helps you avoid the stress of trying to time the market, which, let's be real, even the pros mess up. Why does DCA work? It works because markets are volatile in the short term, but trend upward over the long term. By investing consistently, you're buying through the ups and the downs. And over time, you take advantage of compound growth, the magic of long-term investing. In fact, if you had started DCA into the S&P 500 any time in the last 30 years, even through the worst crashes, you'd still be sitting on some serious gains. Turbocharging your DCA, advanced strategy. Now, for those of you who are a little more hands-on, let's talk about how to turbocharge your DCA strategy. The basic idea is this. You still invest regularly, like normal DCA, but you adjust your contributions based on market conditions. For example, you invest your usual $500 per month, but if the market drops 10% from its recent high, you invest $750 instead. If it drops 20%, maybe you go even higher. You're essentially buying more during the dips when stocks are on sale. It's a bit like value investing meets DCA. This strategy can lead to higher returns over time because you're putting more money to work when prices are low. But here's the catch. It requires emotional discipline, extra cash on the sidelines, and a little more attention to what the market's doing. But here's something important to keep in mind. Too much cash on the sidelines can hurt you. If you're holding back too much waiting for the perfect dip, that money is just sitting there, not growing. You might miss out on potential gains while the market continues to rise. So the key is balance. Make sure you have enough cash to take advantage of market pullbacks, but not so much that you're missing the long-term compounding power of being invested. It's a bit of an art and a science. And that's why this version of DCA is best for folks who are more engaged and comfortable tracking the market. So, if you're brand new to investing, stick with regular DCA until you're confident. But once you've got the hang of it, turbocharging could be a powerful upgrade to take your investing to the next level. How to start DCA today? Getting started is easy. Pick an investment vehicle, like an S&P 500 ETF. Choose your investment amount. For example, $100 or $500 per month. Automate it with your brokerage or app. Stick with it. The key is consistency over time. You don't need to be perfect. You just need to be in the game. So whether you're just starting out or you've been investing for years, dollar cost averaging is one of the most reliable ways to build long-term wealth without the stress of timing the market. And if you're ready to take it to the next level, give that turbocharged version a shot. Just make sure you've got your strategy, your cash cushion, and your discipline in place. If this video was helpful, don't forget to like, subscribe, and hit that bell for more smart money insights every week here on MoneyWise. Thanks for watching, and I'll see you in the next video.